You've been doing the responsible thing. Every month, a portion of your paycheck goes into savings. 100 here, 200 there. It feels good. It feels like you've got your life together. But then you open your banking app and look closely at the number. Say you have $10,000 sitting there, earning 0.5% in interest. After an entire year of doing everything right, you made about $50. This chart shows exactly why that matters. We start with a $10,000 baseline. In a savings account at 1% for 20 years, it grows to $12,200. But in the market, averaging 10%, it rockets to $67,000. Same starting number, vastly different destination. The math is obvious, but making the jump is terrifying. Savings feel secure because you can watch the balance, and it never randomly drops. Investments move. They go down as well as up. And watching money you worked hard to accumulate suddenly shrink is genuinely uncomfortable. You don't have to ignore that instinct. The goal isn't to take a blind leap of faith with your life savings. Instead, you need a calculated process to de-risk your money, protecting long-term growth from short-term panic. Before a single dollar goes into the market, you need a safety wall. That means 3 to 6 months of living expenses sitting entirely in cash. This is boring, untouchable money reserved strictly for job loss, medical bills, or a broken-down car. When people lose money by panic selling during a downturn, it rarely happens because they got scared. It happens because their car died and they needed cash immediately, forcing them to sell their investments at a loss. The emergency fund protects your investments from real life. Visualize your finances as 2 containers, a safety and a growth bucket. The safety bucket holds emergency cash, perfectly flat, shielded from the market. The growth bucket holds investments. It bounces up and down as that volatility drives its expansion over time. Once you draw this hard line in your head, the Bailey anxiety disappears. You stop logging into your brokerage account expecting it to act like a savings account because you already have a savings account doing its job. You also don't need thousands of dollars to get through the door. Most platforms let you start with $50 or less. Early on, the amount matters far less than simply building the muscle memory of transferring money into the market. And you don't need to learn day trading to make that money work. You just need something boring, like an index fund. Looking at this diagram, you see how an index fund operates. Instead of betting on a single stock, it takes your contribution, breaks it apart, and buys a microscopic slice of hundreds of companies simultaneously. Even Warren Buffett consistently points regular investors toward low-cost, diversified index funds over complex trading strategies. This chart tracks investing $300 monthly into an index fund, averaging 8%. Across 25 years, the trajectory curves upward. Your out-of-pocket contribution totals roughly $90,000, but the final balance hits $285,000. That massive $195,000 gap is pure compounding growth. Your money doubling what you put in. Saving your cash is like keeping seeds locked in a sterile glass jar. They are perfectly safe, but they will never grow. Investing is taking those seeds and burying them in dirt. It requires patience and a little exposure to the elements to eventually produce a harvest. But you must know what to do when the elements turn against you. If left in the soil long enough, eventually the market crashes. Crashes are entirely normal. They have happened dozens of times throughout history, and every single time, the market has eventually recovered and pushed higher. When prices plummet, your automated $300 a month doesn't stop. Because the market is down, that same $300 suddenly buys significantly more shares of your index fund at a steep discount. You are now accumulating assets on sale. Once the market inevitably corrects and prices rise again, those extra shares act as a multiplier, drastically accelerating your total returns. It comes down to a strict sequence. Build your emergency safety wall, separate into safety and growth buckets, invest in broad index funds, and let time handle compounding. Saving alone provides stability, keeping your head above water. But putting your money in a position to multiply is what actually buys your time back, finally making your capital work exactly as hard as you do.